A very good evening, and thank you all for joining the call today. I am Shikha Sood, and I lead products at Edelweiss Mutual Fund. So today our endeavor is going to be to provide you absolutely crisp and relevant insights on the US technology market and also an update on our fund, Edelweiss US Technology Equity Fund of Fund, that feeds into the J.P. Morgan US Technology Fund. We are joined by Supreet Bhan and Mariani from J.P. Morgan Asset Management, who would share deeper insights into the US tech equity market and also the fund. So thank you, Supreet and Christian, for joining us today.
Pleasure joining you, and thank you for having us, Shikha.
So starting off with the agenda of the call, we're aware that the US equity markets this year were essentially driven by the US technology stocks. In fact, it was being said that it was being said that where technology goes is where the US markets go. In fact, the tech bulls also say that the tech rally is probably going to continue well into 2024. So the core question, I'm sure, across all of our minds is, what does the path forward look like for the US tech? While, of course, as a fact, we're aware that there are the Magnificent Seven, the Apple, Amazon, Alphabet, Nvidia, Meta, Tesla, Microsoft, which have largely driven the US rally this year. But what's an important point for us to note is that there is a larger set of stocks, a larger cohort, which has probably, if I can put it that way, been left behind in the rally. So their potential is yet to be fully recognized by the market. So which is why we can probably expect that in 2024, the US tech rally can be more broadened, it can be widened. So Supreet, if I may ask you to start off with taking us through the structure of the US technology market and how has it evolved over the decades? And what makes us so positive about this wider set of stocks?
Thank you once again for the opportunity, and to all of you on the call, very good afternoon. Really pleasure to be speaking to you all about this strategy. It reminds me of almost 4 years back when Christian and I were in India marketing this fund for the first time during the NFO, and that was just before COVID. I remember Christian and I were wondering, going into meetings, should we be wearing a mask, should we not? And Shikha, interestingly, we received similar questions at that point in time. And I know that we are almost reaching the 4-year anniversary of the NFO, but we had similar questions at that time because technology for the last more than a decade had driven the S&P 500, just like it's done this year, even though it's been a really concentrated rally. I just looked up the stats just for this call, just to prepare. 75% of S&P 500's rally year till date can be explained by those 7 stocks, which are now called the Magnificent Seven. So only 25% of the total rally of 21% comes from the rest 493 stocks in S&P 500. That's how narrow it's been as well. So it's a good point that you raised. If we jump forward 2 slides, you spoke about the journey and the evolution of technology. Now, let me just first of all say that there's one certainty amongst all the certainties in life, along with death and taxes. One of the certainties of life is that technology always evolves. So what you see in front of you is a slide that you must be familiar with, because if you follow this strategy, we use this. From the 1980s all the way to this decade, you've seen different trends or themes in technology drive the leaders in that technological evolution as that technology has evolved or has been adopted. From mainframe computing in the 1980s, which was dominated by these top 10 names, followed by personal computing in the 90s. The dawn of the internet era, which I'll speak about in just a moment again, and very recently, cloud computing and mobile computing driving some of the leaders that you see currently. There's a lot of buzz, almost a mania around artificial intelligence, and we'll speak about that in detail. But again, if you notice how leadership has changed from the 90s, 2000s to now the 2020, we wouldn't be surprised that if the leaders in the next decade are different from the leaders that you see today as well, because that leadership has changed over a period of time. Let's take an example. So if you go to the next slide, I wonder if most of you remember this. this is the humble floppy disk drive, which used to be, how we used to carry data. So, whether it's music, whether it's images or any other files, this is how you used to carry it. So if you would have asked me in the 90s, which is when IBM used to make these floppy disks and was one of the top 10 leaders, can I envision putting all my data onto something called as cloud? I couldn't have. And if you go to the next slide, I know, Shikha, that you're a lot younger than me, but I remember when I was in college doing my engineering in the late 90s, internet used to be a dial-up connection. It used to make a funny sound, almost like somebody's clearing their throat of phlegm before you could see anything on the screen. And even if you could write, let's say, edelweiss.com, hit enter, you could go make yourself a cup of tea and come back, and maybe half the page would have loaded by that time. And if you would have told me in the 90s that internet will change the way I live, work, socialize, I couldn't have believed it. So in a way, we're at an inflection point for artificial intelligence, which, like the 90s, there was a lot of expectation around the internet. People just didn't know what the application and what the true winners of that internet technology adoption will be. Similarly, while we know the first and second derivatives of artificial intelligence, we don't yet know how that will dominate and change our lives over a long period of time. There are the obvious ones that, GPT and large language models will improve productivity. It'll improve the quality of data and the output and images. But there's so much more. Just like, internet has been adopted over the past couple of decades and led to different sorts of leaders. Watch this space, because there are going to be different companies which are less known than the Magnificent Seven today, which perhaps a few years down the line will start coming into a lot more focus. And which is exactly why we're excited about this opportunity. It's not just about buying what's in those big indices and being passive about it. It's about being actively looking for those opportunities where you can find some of these ideas. So if we go forward one slide, we'll just give you a broad example of how we look at technology. It's not just the pure tech companies. I think trying to compartmentalize the opportunity in technology in just one category is like running a fool's errand, because it really spans across different sectors as well. So some of the obvious ones are obviously media and advertising, e-commerce, payments, and you see some of the names there. But even as the world transitions from conventional fossil fuels towards renewable energy, you will find leaders which are technology-oriented companies that'll be able to facilitate that transition. Autos is a very obvious winner. I'm not going to spend time there, but even a basic requirement of travel and leisure, return of consumer experiences after being locked down for 2.5, 3 years, you do find companies like Booking Holdings, which are using artificial intelligence that I referenced just some time back to be able to increase their revenues. But you also find names across media and advertising like the Trade Desk, which offers solutions, really sophisticated solutions to targeted marketing by big companies which have deep pockets for advertising, and even on the industrial side, like Procore. So I would implore you to keep your thoughts and horizons a little broad when you're thinking about technology. And frankly, we're very excited about the opportunities that exist across technology and technology-enabled businesses. I'll pass it back to you, Shikha.
Thank you, Supreet, for that. So with this this understanding of the wide US tech opportunity, coupled with the fact that the US tech market has witnessed a dramatic shift in market cap leadership over the decades. So, Christian, if I may ask you to step in here, how is the portfolio constructed for the J.P. Morgan US Technology Fund? What is its investment strategy? And also one point here would be critical for our audience to understand. How does it differ from NASDAQ and S&P 500? Now, NASDAQ, we understand, is essentially tech. In fact, even S&P 500, if I look at its exposure to technology and its adjacent sectors, the exposure is almost 50%, or in fact, a little more than that. So here I include, of course, the sectors like consumer discretionary, where Amazon and Tesla are classified. and as well as communication services where Google and Meta are classified. So would be interesting to understand the difference in the portfolios.
Yeah, sure, absolutely, and thanks for having me on the call. It's always a pleasure to join these updates on US Techs. So I would say, first of all, the way we think about technology is really important to understand the fund. And I would say that the way we think about it is that technology investing, a little bit how Supreet has been illustrating on the previous slides, has become less of a sector opportunity and more of a long-term secular opportunity across sectors. And within this fund, we strive to capture the multi-year leaders across this space. So when we think about it, we do believe one need to be flexible in terms of what you get exposure. I think if you go back again 20 years ago, you would have thought about technology very much as traditional IT names, but now the opportunity set is much broader than that. And that's why within our fund, we invest beyond just the traditional kind of IT tech kind of names. So you can see on the left-hand side how we do invest a large amount in the traditional kind of like software, semiconductor names, which really provides the foundational layer. But at the same time, we also invest in other sectors. So you can think about like consumer companies, you can think about some industrial companies using technology to really harness an advantage, but also think about some exposure to we had in healthcare, for instance, or financial as well. So the first one is really being flexible in what you get exposure from a sector perspective. And then the second one is really recognizing that a lot of the indexes you mentioned, from S&P to NASDAQ, they are heavily concentrated in just a few names, like the mega cap kind of companies. And you can see on the right-hand side how, say, NASDAQ QQQ is giving you 36, almost 40% exposure to just 5 companies. The companies that most clients already have in their portfolios, the like of Apple, Microsoft, these kind of names. So when you're investing in something like a NASDAQ, for example, you're really kind of investing mostly in just these few names, rather than the broader opportunity you can find in technology in the US. So when we look at it for our fund, we really have an all-cap approach. What this means is that we are trying to find the best opportunity, the best ideas in technology and technology-enabled names across all market caps. So if you look at the breakdown by market cap that we show for the US Technology Fund in the middle, what you'll notice, I think it's quite interesting, is that we have more exposure to companies which are less than 20 billion in market cap. So you can see about 15%, than in companies which are more than $1 trillion in market cap. And more than $1 trillion is really the Apple of the world, those kind of names. So that's really speaking about the opportunity set. If you invest only in kind of the indexes, is really heavily skewed toward just those few names. But the reality is that the opportunity set in tech, it's really broader than that. Really think about what are some of the new up-and-coming small cap company, which will become the next large cap, the next mega cap in the future. And that's what we are really trying to do here across sectors, across market caps.
And if I may add, some of these concentrated bets in these benchmarks, like 11, 12% in Apple, 9, 10% in the next largest company, just as a part of the benchmark. It's almost like back in the 90s, just assuming that IBM cannot be disrupted, because IBM used to be in that position. And clearly 20 years later, we know where they are. So it's really our ability to capture the future Apples, the future Teslas, the future Microsoft, really drives the performance of this strategy, which is why the chart on the right, or the graphs on the right-hand side of the slide, are very, very important, which is we only have 13% in these top 5 stocks, where NASDAQ 100 actually has about 36, 37% in those 5 stocks. So really depending on our expertise of being able to identify the future large caps that drive the performance of this strategy.
Sure, great. So just to complete the loop here, I think it would be helpful if we can compare the performance of the US Tech Fund or its benchmark against NASDAQ and S&P 500.
Okay, let's do this in two ways. Let's just first look at the US Technology Fund versus its benchmark, which is the Russell 1000 Technology Equal Weight Index. As the name suggests, it has equal weighted across several technology companies, which we believe is a more accurate way of capturing the technology opportunity rather than a very concentrated portfolio where only 5 stocks contribute about more than 1/3 of the portfolio. So on this slide, the top half, you're seeing point-to-point return. Now, let me break that up for you. The top row shows you the performance in US dollar terms. That's a JP Morgan fund. The one just below that is in INR terms. So, for an Indian investor, that is in INR terms. The technology index returns are in US dollars. So an apples to apples comparison is the top row, the US dollar, versus the technology index. And the excess return that you see below that is the outperformance of that US dollar return of the US tech fund compared to the technology index, which is also in US dollar. Hopefully that's clear. So whether it's year till date, whether it's 1 year, 3 year, 5 year, 10 year, and this strategy goes back a long time, it has consistently driven outperformance relative to the benchmark. But it doesn't mean that it's not a volatile product. It is a high growth, volatile strategy, which is why you'll notice 2022, which is when the Fed started hiking rates and raised it to levels that we haven't seen in the past 20 years. The technology cohort sold off a little bit, and the fund at its lowest point had a drawdown of about 44%. But year till date, with a performance of about 34% till October, this does not have the rally in November. It's also managed to recover a fair bit of that as well. So it does show you characteristics of driving consistent alpha versus its benchmark. There are brief periods when it's underperformed the benchmark, but it does make up, like for instance, in 2022, we gave up 10% relative to the benchmark. But year till date, even till October, we've regained more than that in the form of about 16.5% of alpha. Now, shifting gears a little bit. So if you go to the next slide, this is where we're plotting 1-year returns, rolling returns of the US tech fund relative to the two most popular benchmarks in the US. One is the S&P 500, which is given in the red line, and the other one is obviously the NASDAQ 100. The way to view this graph is if you look at a point in time, that's the level of 1-year return if you would have looked at it at that point in time. For instance, if you look at the return at the start of this chart, which is probably around the time that Chris and I were in India in 2020 marketing this fund, the 1-year return at that time was showing roughly about 45%. And obviously at the peak of the hype around technology during COVID, it reached about 140% returns. And that's how you view this. The one thing I want to point out is, of course, this is a strategy which has a higher up capture ratio, which means that when the markets are supportive, it gives you a higher upside. But obviously, when you go through a period like 2022, which is when the Fed slammed the brakes on the economy and interest rates went up significantly, drew down more than the other two benchmarks as well. But if you notice through the period of the last almost 10 years or 5 years of rolling rate data that we've shown, the 1-year rolling data does tend to tell you that it does outperform the other two benchmarks. More importantly, the NASDAQ, because a lot of times the comparisons are done as a proxy, or NASDAQ is assumed as a proxy to technology investing, which I might say NASDAQ by definition is the top 100 companies globally that are non-financial. And to Shikha's point, it's just that most of those companies have tended to be technology and technology oriented, but you will find a Coca-Cola and a McDonald's in the NASDAQ 100 as well. We just don't think that's the best way to capture technology opportunity, nor do we think that the best way to capture the future leaders is by allocating almost 35% of your capital to just 5 stocks. So hopefully this data in front of you shows you that the fund is able to use that risk budget, that tracking error, to deliver outperformance relative to the benchmarks. And of course, S&P 500 is a much more diversified benchmark, even though it does have concentration now on technology, but it clearly is not the way to play technology. Whereas this fund, through its life, has shown you its ability to deliver outperformance.
That's very helpful, Supreet. Thanks for that. So just going back on our performance, on the fund's performance, and now getting more deeper into it. So specifically for last year's performance, I'm sure this is one question that a lot of our participants would have today. So if we can look at our last year's performance from two perspectives. One, if you could help us understand what were the drivers for the tailwind of the overall tech market last year. That's number one. And number two would be that against this, what worked for us? What were the calls? What were the stocks? What were the themes that worked for us last year?
Yeah, sure. I'll take this one. I mean, we show here some data in terms of the attribution, but I won't spend much time here. But I would say that generally speaking, I think it has been a little bit more concentrated market over the last about almost 12 months since the beginning of the year. So what you see is that also for our alpha generation, since the beginning of the year, some of the more larger cap names are showing up as top contributors. So you can see on the left-hand side, NVIDIA, Meta, Tesla, Amazon. These are kind of some of those like larger names. But broadly, I would just say the big picture is that stock selection was really driving alpha for us across the portfolio. So if you look at the bottom, you can see whether it's that the internet space, whether you're looking in places like semiconductors, for example, that's where we have been generating like alpha for this portfolio. One thing I would say, however, is despite, you might look at NVIDIA being the largest contributor to performance this year. One thing which is important to recognize is that, for instance, we had a position in NVIDIA since 2016. So that's not just like a brand new name we added to this portfolio over the last 12 months, but actually it's a company we had in our portfolio now for a very long time. And going back to what we are trying to do in this portfolio, really trying to capture the leaders of the next 5 or 10 years, I think NVIDIA is a good example of like, a name we identified a long time ago as one of these, potential leader, and we scaled up that position, especially at some point towards the end of last year, given how large the drawdown was in 2022 for some of these like tech names, like seeing the opportunity that this company can really be one of those leaders overall. So starting that position 2016 and using the 2022 drawdown in tech to scale up the position, given valuation were looking quite attractive for us, that benefiting us in 2023. But at the same time, you can see names like Synopsys, for example, which is, again, not a name which maybe many people will recognize as in one of the top contributor. And that's a company which is, behind, I would say, any semiconductor almost, because it's a company which provides the software which is being used to design semiconductors. So it's not only about these very well-recognized companies, but also other names which can provide an attractive upside over time. Synopsys is one of these examples over the last almost 12 months for us.
That was very helpful, Christian. Thank you for that. So moving on now to the future. Now, going forward, we would like to understand that to take advantage of the key themes and the new ideas and new opportunities, how is our portfolio currently structured? What are the key themes we are bullish on, and what are the topics for the next 1 year, or in fact, even for the next 3 to 5 years? So another point that I in fact came across was that among the key themes, the spending on cloud and artificial intelligence is set to go up by 20 to 25% in the coming year, which is a modest rise, which is higher than a modest rise that is expected among the overall IT spends. So this is clearly a key positive. So while that is on the demand front, what I also understand is that a lot of companies, now of course they all understand how the US market, how the US tech market leadership works, and it constantly evolves. So a lot of companies are spending and continuously spending on reinventing through R&D expenses that we can see. So again, from that perspective, also the companies seem ready. So how do you see our addressable market shaping up, and what would be the competitive advantage of our companies in the portfolio through which our investors can see positive outcomes?
Sure, I'll take this question. I would say, first of all, as we look into next year, from an outlook perspective, I think you rightly pointed out that we see an improvement in some quite attractive like growth rates in places like clouds. That's one example there. But I would say, overall, as we talk to companies and we kind of like have a good overview of like what we are seeing in terms of like IT spending and like technology spending, we are quite positive going into 2024. And like what we are seeing is that if you take cloud as an example, over the last few years, and what we've seen is in 2020 and 2021, we have seen massive spending on clouds because of the world we were living on. And in years like 2022 and partly this year, at the beginning of this year, you have seen actually a lot of the cloud providers have been working through trying to help a lot of their clients to reduce cost. And as that happened, what happened is on the cloud spending went through a weaker period. But as we go past that phase and into next year, that's something that we're already seeing. We have seen it over the last quarter or so. If you follow, for example, the results from AWS, Amazon Web Services, like Google Cloud and so on, you start to see like an uptick in terms of like cloud spending once again. So this is something, for instance, that makes us positive in terms of the outlook going into 2024. At the same time, another area which I think is interesting, just simply from a perspective of going into 2024, from an earnings growth perspective, is also semiconductors. Similar story, semiconductors are going through in 2020 through a quite hard time in terms of like their earnings growth. They're going through actually negative year-over-year earnings growth. Most of the semiconductor names, except, for example, NVIDIA. But what that means is that as you go into 2024 and parts of the market start to recover, I'm thinking about like, PCs and laptops being one area which have seen quite weak results over the last few quarters. That's also providing an upside to growth like into next year. So I'd say overall, broadly, you do see an attractive like, set in terms of like the growth going into 2024 for some of the larger parts of like tech, software, cloud being one of that. And you can see we have quite a large exposure, about 34% of the fund is in software. You see on the right-hand side, and then definitely semiconductors where we have, about like 16% exposure. If you look again on the right-hand side of that chart as well. So once again, I would say the opportunity from a growth perspective into next year is definitely better than what we've seen in 2024, on that. The other thing I would point to is that in terms of what we are looking for and how our companies are positioned, we are trying and we have been focused in terms of on opportunity perspective, something that you don't necessarily see on this slide. If I look through the names we've been adding in our portfolio over the last like 11 months or so, have been predominantly down the market cap spectrum. So while you might focus just on the top 10, you see some of the larger names here, the mate of the word alphabet. I would say that the majority of the new names which got into the portfolio since the beginning of the year are predominantly in the small and mid cap, part of the market. And I think that's talking about the opportunity we see there, especially given how small and mid caps have been underperforming on a relative basis to a lot of the larger mega cap over the last couple of years. So just mention a few names like which entered the portfolio. Vicor is one name which we added earlier in this year, which is in that space. Rambus Semiconductor, that's another one. Company called Axelis, Onto Innovation. These are names which are like not many people are familiar with, I would say. And that's really where we are seeing an opportunity over the next 5 years for this company to really capitalize on growth opportunities. Most of these companies, the opportunity is really related to AI and the heavy spending, which is going to go in the next few years, really upgrading, a lot of within the data center world, for example, within semiconductors, and really trying to solve for some of the issues which are there with also AI workloads over time. So we're finding a very good, I would say, set of opportunities, beyond just the large cap names in the small and mid cap of the markets. The last thing I would say is that if you look at the names in the top 10, you won't find Apple. And I think I would just want to spend 1 minute there. We are being very selective in terms of the mega cap exposure. Apple is a name we have less than 50 basis point exposure as of the end of October. And that's in big contrast with what you see, for example, in Meta. So I would say from a larger cap perspective, it's not that all these names are necessarily bad in our view. We are just being much more selective. Where are we willing to pay, the valuations for these kind of names? And again, the risk reward we see in Apple is not as good, and what we see in some of these other names, for example, Meta, like Nvidia, will be another example there. So selective is really the key, we think, going into 2024 for our portfolio.
Sure. But an important point here now, Christian, that there are a lot of concerns around valuations, specifically on the top 10 stocks. While, of course, we will not be avoiding these stocks are very much going to be part of our portfolio. So therefore, what would be the key catalyst from this point for these stocks to go further up? Of course, we understand that this year was more about profitability was driven by efficiency. Reduction in fixed cost, and going forward, in fact, moving ahead into 2024, any growth in bottom line would essentially hinge on revenue growth. So therefore, it would be important for us to understand where are these valuations going to go ahead from this point for the top 10 stocks specifically. But of course, we also spoke earlier about the wider set of stocks, the other stocks where we haven't seen as much rally as a Magnificent Seven. So it'll be helpful to understand what's your view on the valuation of those set of stocks.
I'll take the first part, just try and distill the Magnificent Seven versus the rest of the market. And Christian, you can bring it home with some of the sectors and how do we look at valuations across different sectors as well. This is a very important slide. And in my initial comments, I mentioned that 75% of the rally in S&P 500 was dominated by these Magnificent Seven. So the team actually put together something very interesting as of end of September this year. So this data is already outdated, but even as of end of September, when the market hadn't experienced the kind of rally that we've seen in November, you can clearly see that Magnificent Seven on the left-hand side, which is shown in the light green line, trading at about 26.8 times P multiple. Now, remember, this is before the rally in November. And compared to its long-term average valuation, which is again given in that solid green line of about 22 and a half, it's clearly not attractively valued. But if I bring you to look at S&P 500 at the same time, which is in dark blue, you realize that the PE multiple of that index is at about 18, which is not tremendously expensive compared to its long-term average of about 16.5% or 16.5 times. But the moment I strip out those top 7 companies and look at the remaining 493 companies in S&P 500, let's call them S&P 493, they actually on this chart look slightly more attractive compared to their long-term average as well. It goes to show that valuations are an issue for a very small cohort of mega cap names. And Christian referenced QQQ. Shikha had a question earlier on NASDAQ 100. Just for your reference, in October, or as of 1st of October, the P multiple of NASDAQ was close to about 33 times forward. The same number for our US tech fund is about 25 as of the same day. So it clearly shows you the gap in terms of valuation and where do we find slightly more demanding valuations from a long-term perspective. On the right-hand side, this addresses the software category, which, as Christian pointed out in our sectoral breakup, constitutes almost about 34% of our fund. It went through a massive de-rating in terms of its multiples, and today is trading at valuations that we last saw around 2018 or 2017, well before the big run-up in technology stocks and particularly software stocks during COVID and the hype around COVID. So it's given up all its COVID gains in terms of valuations, is now trading at levels which was last seen almost about 6 years back. Christian, let me pass it to you for the sectoral breakup.
Yeah, sure. Maybe I would just add one thing on the Magnificent Seven. And again, going back to the point of like being selective, I was talking about how Apple is an extremely small position in our portfolio, which is typically what you don't expect in a tech fund, at least a US tech fund or global tech fund. I think you kind of need to think about like how much you're paying for the growth, to one of the points that was made before. And actually, if you look at like the valuation of Apple, right now it's trading based on next year earnings, kind of in line with almost NVIDIA. And in our view, like the growth that is able, to give you a company like NVIDIA, which is a clear lead in AI, in terms of both the semiconductor parts and GPUs, but also providing the software behind it, it's just like much, much more attractive compared to a company like Apple, which is ultimately still, a large part of it is still handsets. So smartphones, iPads, and so on, which are not really going to grow much over, the longer term. So I think it's really an opportunity to try to kind of, focus on where you're seeing the best growth opportunities and you're willing to pay some of these valuations, and kind of like reduce risk in other areas, Apple being one of them. The other things which I think, when one think about US equity valuation and compared to other areas, just on the next slide, I think one needs to be mindful of you're having like huge divergence in terms of sector exposure between the S&P 500, which is in this case, we are taking as the example for US large caps, and all other developed markets. So in this case, we are showing MSCI EAFE index, which is simply, Europe, like Japan, like most of the other developed markets in the world, ex-US. And what you see here is that the US, given the lead in tech, has, a major overweight in communication services and information technology. And to me, it's not surprising that it's trading at a premium compared to the rest of the developed markets, which they have much less exposure to these more innovative and growthier parts of the market. So you can see for MSCI EAFE on how information technology is actually less than 10%. So again, once you're comparing, you kind of need to take into account for these sectorial differences. And ultimately, it's also about the earnings growth that you're able to deliver over the long term. So if you can go to the next slide, I think what's interesting to show here is that if you look over the medium to long term, so here we are looking at 15 years, looking back 15 years, and we're comparing S&P 500 on the left-hand side in terms of the earnings per share, 12 months trailing. We are starting from 100 and seeing what's the trend over time, over 15 years. We compare to the other developed markets like EAFE and emerging markets as well. And what you can see is that the earnings in the S&P, thanks to mostly these technology companies, have been able to grow like much, much faster than the other markets, where actually earnings didn't really grow over the last 15 years. And if you're able to grow earnings consistently and outpace, growth expectation over time, that's leading you to better performance. And you can see that on the right-hand side on the S&P, like materially outperforming these other areas, whether it's that other developed markets as well as emerging markets as well. So it's down, at the end of the day, it's really down to the ability to deliver earnings growth, which we believe these companies, technology companies we invest into have, delivering then better performance over time as well.
Sorry, I just had a bit of a technical issue. So this was very helpful. To just moving on, so we've spoken a lot about the US tech market, the stocks, the themes, but of course the US market cannot be looked at in isolation. The macro variables play a significant role in how the US tech markets and the US markets in general move. So in fact, the two areas that even Fed takes a decision on the interest rate trajectory, which is inflation and jobs market data, are very significant to watch because they have significantly driven the financial markets in the past. In fact, the US jobs market data was out on Friday, and we noticed that the US markets closed higher. In fact, the S&P 500 and NASDAQ notched their highest closing level since March or April of last year, if I'm not wrong. And what do you accord this to? So do we see that, can we translate this into investor optimism of a soft landing for the economy fueled by the positive jobs market data? What would be your outlook going into 2024, and how do you see that impacting the performance of markets?
Let me take the first part, and I'll pass it to Christian to take on the tougher part of your question, Shikha. So if you can go to slide number 22, let me address the question on the big question of inflation. We all know that the Fed embarked on its aggressive rate hike campaign just because of the sticky inflation that the US economy has been experiencing. Now, if you've been following the developments, obviously it's beginning to cool down a little bit, but even if you were to look at the core CPI, which is given on the left-hand side, now I'm giving you 3 different scenarios here. What if the core CPI cools down or grows month on month at different rates, like 0.3 month on month, 0.2 or 0.1? Now, we're not here to make a judgment or a forecast. We'll allow you to do that. The previous print was that the month-on-month core CPI grew by about 0.2. If you were to follow that, it means by middle of next year, that the inflation in the US should cool off to close to about 2.42%, which is close to the Fed's target of 2%, which means it gives the flexibility to the Federal Reserve to take the foot off the accelerator. Now, if that is the case, on the right-hand side, what we're showing you is that whenever the Fed stopped hiking rates in the past after their rate hike cycle, what has been the experience 12 months out with regards to different asset classes? And what we've done for you for a US large cap, we've highlighted that in the red rectangle. And the way to view this is there are different points. There are 5 different episodes when the US economy or the Federal Reserve stopped hiking rates. One was a period in 1989, 1995, 2001, 2007, and very recently in 2019. The range of the bar shows you the range of returns through those periods. And the specific colored diamond shows you the 1-year return in that period. So for instance, if you look at the purple dot, that or diamond, that shows you what would have been the return when the Fed stopped hiking in 2019. The horizontal black bar shows you an average return. Now, one thing to take away is 2001 was bad for most asset classes because that was not just the Fed stopping hiking rates, it was also coincided with the dot-com bust as well as 9/11. But even including that, if you look at the average returns, it does gravitate more towards mid-teens to high teens as well. So Fed potentially pausing does signal a sanguine or an optimistic signal to the markets, which perhaps explains the bulk of the optimism that we saw in the month of November. But why don't I pass it to you, Christian, to speak about what's actually going on in earnings, which ultimately is the primary driver of returns over a long period of time.
Yes, sure. So if you go to the next slide, I think, there has probably been over the last, few calls, a lot of discussion about, what about potential recession in the US. And I would say when you look at the earnings side, well, the broader US economy never really fell into recession. Actually, we're seeing strong growth. If you look at GDP, parts of the US equity market went through an earnings recession over the last year and a half. So what you're seeing here on the left-hand side, those bars are telling you how much of the S&P over the last few quarters experienced an year-over-year negative earnings growth. And the green part of those bars is actually the information technology sector, which is very relevant for our fund. So you can see how between the third quarter of 2022 and the second quarter of this year, Infotech went through negative earnings growth. What's happening right now is that we are coming out of that. So you can see how these bars are becoming smaller and smaller as we progress towards the end of 2023. We are seeing improving trends in terms of the earnings growth. So more and more company actually reporting positive earnings growth compared to previous quarters. And that means that overall, we are seeing upside in terms of earnings growth going into 2024. for next year. And you can see that at the broader kind of index level at the S&P on the right-hand side. And you can compare the estimates we had for 2023 at about flat to slightly negative to then 2024 being low double-digit earnings growth for the S&P. Once again, when you think about the US technology, you need to think about that we are investing in higher growth companies. So our expectation in this case are much higher than the S&P 500. And if I would just go back to slide 15, you can see the EPS growth expected for the next 12 months for the fund is currently sitting at about 26%. So once again, from earnings perspective, we do see better trends into next year for the broader markets, but then even better trend, I would say, for the technology sector and the companies we invest into for us. I just want to take the last minute and address the question of like the market has been rallying and what that means kind of like, going forward. If we could go to slide 20. I just like try to make it simple here. And, if you look on the left-hand side, what we've been looking at, what happened to the market, in this case, the S&P 500, after the S&P rally 20% or more from a 52 weeks low. We experienced that 52 weeks low last year. And you can see that as a green dot on that line chart that you see. But we look over the longer term, what that meant for forward-looking returns. So what you see in the table is, if you take from that point, after you reach that 20% like rally from the previous 52 weeks low, on a 1 year basis, the average return for the S&P has actually been positive at 16% on average. And 82% of the times have been positive. However, let's say I'm just taking a kind of a more medium to long-term view, 3 to 5 years forward. Not only the average return is positive, but that's coming with 100% of the time is actually being positive. So I think you can kind of, for sure there will be times, there might be months where the market is volatile. We might experience some small drawdown, but if you just take that 3 to 5 years view, actually it has been a pretty decent time to look at investing in the equity market, even after a 20% rally from the previous low we experienced.
Oh, thank you, Christian. Thanks, Supreet. So this is a good time for all participants to post your questions in the comment box, please. So then we can take up your queries right now. So I do have already some questions, but before that, we've spoken a lot about the US tech market, the positive aspects of it, but it'd be good to understand what you identify, Christian and Supreet, as key challenges for this market going into, it's an election year, of course. So what are the key challenges that you see to the US tech market?
I think let me take a stab at it, and Christian, please to jump on. So there are risks, and one of the biggest risks many of us are aware of is policy. So what if the Fed isn't done? What if there is a negative surprise from inflation? It turns out to be stickier than what the market is expecting. Because don't forget, a large part of the rally in November is predicated on an expectation of a potential rate cut coming sometime in the first half of 2024. If that gets kicked out, if there is potential that the Fed can hike even further, the market will have to adjust that in valuation. Then, of course, that means some of these technology companies can derate. So, you've got to think about that a little bit. Geopolitics, always an unpredictable issue, particularly, with the incumbent and the challenger. You are going to hear America first, make America great again. Well, if anything, it sounds to me like it's going to be good for US companies. It'll be challenging for some of the allies, some friends, some of the suppliers and exporters to the US. But America first will probably mean good things for local companies. Christian, your views?
Maybe I just add to that. I would say if you can go to slide 21, I want to show the right-hand side, kind of linked to election. And I think irrespective of which party is going to win, which candidate, there will still be a heavy, focus on reshoring, especially in areas which are seen as strategic, like semiconductors being one of them. And you can see here, since the launch of the CHIPS Act, how, manufacturing construction across different technology items have been picking up substantially in the US, which wasn't the case just a few years back. So I think irrespective of the result, we will likely to continue to see a focus and investments in that, which are positive for US companies overall. But I think it's fair to assume there will be volatility as we get closer to the election. But I think I always point to the example of, if you take back in 2018, when, Trump won the election, everybody expected the market to sell off, and to sell off like quite a bit. And the reaction was completely the opposite. So I think it's better to kind of, specific to politics, to simply stick with like kind of a medium to long term view, which actually it's, the change tend to be not dramatic in terms of like the policy, especially as it comes to technology companies at this point in time. But it is, probably something which will increase volatility.
So thanks, Christian. So I think it'll be helpful if we can go back to the slide which had our current portfolio and key overweights, underweights, because so there are two related questions. So one is the more of a clarification, if that can be shared. So there's a comment that being underweight the Magnificent Seven would have led to underperformance last year. So that is one point. And the other point is around how different is this portfolio versus the FANG?
Yeah, sure. I'll take that one. I mean, I would say for sure, large cap, mega cap names are a little bit more defensive when you go through, a sell-off, such as the technology sector experienced last year. So in that sense, I would say, definitely it would have led to an underperformance. But I think, if one client invests into this fund, it's probably because you have a positive kind of view over the medium to long term on the technology sector. So we think when you see upside to the technology sector, looking beyond just those, few names, it's really the right approach. And I think over the long term, that proved to be the right one for our portfolio. And at the same time, I would say, especially after the market has been so concentrated in terms of the rally, like really like looking beyond these names also provides like a better, I would say, risk reward at this point in time. So really kind of thinking about how can you decrease some of the risk of concentration you might have in your portfolio, and US Tech is giving you some of that, given we are not heavily concentrated on these names overall for us. And in terms of like the FANGs names, we do own them. And as you can see from the top 10, in some case, like Meta is one of the it is the largest position we have on this portfolio, but it's really being selective among them. So in this case, Meta is a 6% position, but on the other hand, Apple is 50 basis points or less for this fund. So we're really trying to find, which of these companies have a better like opportunity over the next few years to really outpace growth expectation. And in the case of Meta, that's a company which invested heavily on AI over the last few years, and actually one that we think can really benefit from it across their platform to monetize the opportunity. Just think about like the ability to leverage the data they own about all of us to better target advertisement, for example. And that's also a company which has been very lean on cost, if you look what they've been doing over the last 1.5 years. So that gives us like a very different proposition compared to, again, a company like Apple, which is trading at higher valuations than Meta, and it doesn't have those tailwinds, at least it's not clear right now, from AI, for instance. So we will own some of the FANGs, but in a much more, I would say, selective way. And also in terms of the weighting we have, as you can see, we're not heavily concentrated compared to a Nasdaq, for example.
I'll make a quick correction there. The comment that it's underperformed is not entirely accurate. I just pulled up some numbers year till date in the last 1 year. So year till date, the US technology fund of J.P. Morgan's up about 55%, whereas the Nasdaq's up about 47%, clearly outperforming last 1 year. Point to point, this is as of last week, 47% for the US tech fund and about 34.7% for Nasdaq. Even though Nasdaq's not the benchmark, it's outperformed the Russell 1000 equal weight benchmark, but it's also outperformed what people perceive to be the other bellwether index representing technology, which is NASDAQ 100.
Sure, thanks for that. Another question again on the top stocks exposure. So we spoke about, I think this is where it's coming from. We spoke about that we would be taking exposure to the widest set of stocks beyond the top stocks of Magnificent Seven. So I think it'll be helpful if we could clarify on the market cap of these other sectors. So we presume that this exposure is not going to come only from the mid and small cap stocks. So there would be other large cap stocks as well through which we would be taking exposure in this portfolio. And also if you could share again, what would be the likely split between these companies in terms of market cap between large, mid and small of these wider set of stocks, the other stocks that we would be taking exposure to?
So let's start with slide number 15, and Christian, jump on, please. Slide number 15 has some of those characteristics. So this fund, the weighted average market cap is about $320 billion, which is clearly larger than the benchmark, which is the equal weight. So it shows you its tilt towards larger caps. But how does it compare to, let's say, NASDAQ 100? NASDAQ 100 weighted average market cap is about 850 or 900 billion. So this shows you the difference in what we are able to capture in terms of some opportunities in the mid and the small cap space as well. And that's given on the bottom left-hand side. So you notice that 65% of the fund is in companies beyond 50 billion. It doesn't give you a great representation because a lot of companies are close to $1 trillion as well. But you start seeing close to about 36% of the portfolio, 35% of the portfolio sitting in companies between 10 to 50 billion and less than 10 billion as well. So it goes into the comments that Christian made earlier, which is we want to be able to identify the future large caps which aren't a part of the NASDAQ 100, because the NASDAQ 100 will only buy the 100 largest non-financial companies. So they really ought to be already one of the largest giant caps as well, whereas this strategy is able to capture the future winners. Christian?
Yeah, sure. I would say, along to what you mentioned, like we're really focusing, on having that large cap component, but not all the kind of like, concentrated too much into that. Also in the other sector, I would say outside of tech, we do have some large cap exposure. Within consumer, it would fall a company like Amazon or Netflix, for example. They're not technically technology companies, but they're consumer companies. And then, on top of that, we do have quite a few like small and mid cap names also in that space as well. So some of the companies which Supreet highlighted at the very beginning of the call, we have one chart, I think it's slide 6. Some of these companies are falling, for example, in the mid cap space as well, where you're looking on like media advertising, like the Trade Desk, like commerce and payments, like Mercado Libre as well, or in the smaller large cap side of the spectrum as well. So we do have some of that exposure there as well. I would say our way of thinking is always all cap in nature. So we're not going to say no to one specific part. We always try to find the best ideas across the entire spectrum.
Also, there's an extension to this question that is there any minimum exposure as per the mandate that we would take to any of the market caps?
Not necessarily. I would say by guidelines we don't have. So we could technically have, say, 0, or like we could have 10% in any of these areas. It's more driven by the opportunity and the risk reward that we see like in these areas. I would say when you're investing in small caps, for example, you likely don't want to like have a huge concentration as well there. So we're likely to take like, smaller bets on single names, given the volatility you might get into small cap names. But over time, as these companies progress and become mid cap, we see, the company management team executing the growth to come through, then we are willing to scale up positions over time. As this company become, like generally speaking, also less volatile, more liquid overall. So there is no set kind of like number, I would say, we have, but I would expect the bulk of the portfolio to sit really in mid and large cap. And then like some exposure on the small cap and some exposure into the mega cap, as we've shown at the beginning, but that's not kind of forming the largest part of the portfolio.
Sure. So I understand we've exceeded our slotted time, but if I can just take one last question on what can be the use cases of AI?
What could be the use case?
Of AI, artificial intelligence.
Okay.
So how is it used across companies, across sectors? If you could probably take examples of some of our portfolio companies, I think would be helpful.
Yeah, no, definitely. I mean, I do think like, the use case are, can be a lot, and some of the use cases are probably not even clear right now. We might get new use case, say 5 years down the road, as the technology kind of becomes more mature overall. I think like the opportunity right now is coming mostly on two fronts in terms of the use cases. One is in terms of the enterprise use case. And I'm thinking about Microsoft and what they've been doing as one good example of that, on how AI can be integrated in what we use every day in terms of the softwares, something like Microsoft Office. So that's more related to the enterprise and how it makes all of our job more efficient and faster over time, and really kind of helping us to focus on more added value kind of areas. So that's one use case I would say, which can be really huge if you think about the market, the addressable market for that. The second one is more on the consumer side of things. And I would pick, again, I talk about Meta platforms and how they have a huge opportunity for AI to really monetize, in terms of on the consumer side of things, on how they target people, and, targeted advertising being one example of that. But just think about any company which really have access to data sets about consumer can leverage AI to really turbocharge their business in terms of the ability to monetize on the opportunity over time. So I think right now we just give these two kind of broad examples, kind of the enterprise side of it and the consumer side of it. But over time, you will see application across every single sector. Think about industrials and how AI can help to make each process more efficient, to minimize the chance of seeing any errors over time, and to save money, to places like agriculture, like a company like John Deere, which is already using AI on some of their products to make effectively this machinery much more precise when they spray pesticides or when they spray fertilizer. And that's helpful for the farmers in terms of reducing the consumption of these products and improve their margins over time. So, I think it's really an open-end opportunity. And again, 5 years from now, we might be here and talking about some use case which we couldn't even envision right now. But I think that's kind of really the the good thing about technology. And how
I think one of the other areas could be healthcare as well, Shikha. So could AI be used in diagnosing and identifying some critical illnesses early on? I think that'll have tremendous application in the field of healthcare and medical diagnostics as well. So to Christian's point and my earlier comment, like the internet of the 90s, it's really blue sky when you start thinking about the use cases. We know the obvious ones right now, but there are less obvious ones which will become apparent as the technology evolves and the adoption picks up as well.
Sure, thank you for that. And okay, I did mention that would be my last question, but I think this is an important one. We did speak about it, but I guess it'd be helpful if you go back to the slide on statistics, the portfolio statistics, which has the P and earnings, because there is a question that our P is much higher than that of the benchmark. So I guess if you could just give a little more details on the reason, it's probably relation to its earning potential.
Yeah, definitely. So I would say we always expect it to be higher than the benchmark in this case, but that's coming with an EPS growth estimate, which is also much, much higher than the benchmark. And I think if you just focus purely on the multiples, you're going to miss out a lot of opportunities in technology, because it's really about the growth opportunity. And if a company can deliver over the next 1, 3, 5 years upside to growth, actually the multiples are going to come down over time. And I'll give you one example of this is NVIDIA. The company is up, more than 150 to 100% year to date. The valuation actually improved. Why is that? That's because they've been able to grow earnings much faster than what consensus was estimating at the beginning of the year. So you kind of need to look at the two things in combination when you look at it over time.
Sure. So thank you all. Thank you all participants for joining. I'm sorry if I couldn't take any of your questions, but please feel free to reach out to your relationship manager, and we'd be happy to help with any data point or any further queries that you may have. So with this, can I hand over to Supreet for any closing remarks, please?
It's been a pleasure speaking to you and your clients on this call, Shikha. Thank you so much for this opportunity. We believe this is a multi-year opportunity. It's a secular trend. So, regardless of the current macro situation, we believe, at that point started off by saying that technology as a space, one constant is change, and leadership will evolve over a period of time. There will be innovation. You referenced one of them, AI. You will see different leaders over a period of time as the adoption of that technology spans across different. And I hope through the discussion today, that came across clearly as well, which is that it's not just what is categorized as technology, but a lot of those companies which may be beneficiaries of adoption of that technology that really benefit from the evolution and the penetration of that technology. And finally, through a lot of our conversation where we've compared it to the benchmark, the NASDAQ, hopefully the flexibility to invest across market caps, not just allocate bulk of your capital to what are today giant caps, but have the flexibility to identify the future winners and to bet capital on them. And the evidence of that in the form of performance, both long-term as well as near-term, hopefully that came across as well. So I'm really grateful for your time and for all your questions as well. And if we don't see you before the year end, wish you a great 2024. And I hope to bring Christian across to your market and hope to see you face to face sometime in 2024. Thank you, Shikha.
That'd be wonderful. Thank you for that, and wishing everyone a very happy New Year. Thank you for joining. Thanks, Supreet. Thanks, Christian.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.